Something far bigger than price action is quietly taking shape in the global monetary system, and Alasdair Macleod is pointing to a shift most investors aren't prepared to think through yet. The discussion around China potentially reintroducing silver isn't about a dramatic announcement or a headline-grabbing reset. It's about timing and control. The priority, as Macleod explains, is not silver first, it's gold. Gold is being used to anchor confidence in the yuan for international trade, especially as trust in the dollar weakens. Only when the decline of the dollar becomes undeniable, and critically self-inflicted, does China gain the space to act without being blamed for triggering the collapse. This is a defensive strategy, not an aggressive one. What comes next is more subtle and more dangerous to the existing system. International trade settlement and domestic monetary stability are being treated as two separate problems. Central banks are comfortable moving gold between themselves, but deeply uncomfortable allowing citizens direct access to it. That's where silver re-enters the picture. Historically, silver already functioned as money inside China, and that memory still exists culturally. Reintroducing silver domestically, while gold underpins international trade, creates a layered system that protects internal stability without exposing strategic reserves. This structure only works where capital controls already exist, which is why China, and potentially India, are uniquely positioned. Exchange controls allow a clean separation between domestic currency use and international settlement. At the same time, the yuan is being positioned as the preferred trade currency across large parts of the global south, the Shanghai Cooperation Organization, and regions increasingly operating outside the dollar system. Gold is visible in this transition. Silver, so far, is not, which is precisely what makes its strength inside China so revealing. According to Macleod, if these pieces are aligning as suspected, the implications are extreme. The gold-silver relationship would not adjust gradually. It would snap back toward historical norms, forcing silver dramatically higher. This wouldn't be driven by speculative excess, because speculators aren't even present yet. This isn't an investment cycle. It's a monetary one. And as fiat confidence deteriorates faster than inflation models suggest, the repricing pressure accelerates into 2026. By the time the broader market recognizes what's happening, silver won't be catching up, it will already have moved on. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters.
I think China is probably going to be the only country which does this. Because they've got exchange control. Actually, actually thinking again, I suppose it's possible that India might do something similar. That's certainly possible. But I think the whole basis of this is that really what we're looking at the moment is what they're doing with gold and securing the value of the yuan for international trade purposes. That, I think, is the key thing. So everything is, if you like, slightly subsidiary to that. They will do that, I think, when they determine that the dollar is really going down. This is something they don't want. And when it becomes absolutely obvious to the world that the Americans are killing their own currency, then I think China can act to protect themselves, if you like, which is actually what they will be doing. But you can see they just, they are sensible enough to know they do not want to be blamed for collapsing the dollar. The dollar has got to collapse itself, which, thanks to President Trump, is roughly what's going on. So I think that's really the first stage. We then have to consider if this is going to be just limited to trade settlement, which I believe is the case. The reason I believe is the case is because central banks, they hate parting with gold. They really do. God, we don't want to give this to the people, for goodness sake. You can see that they really see this as something which, the people shouldn't have. This is far bigger. Okay. So you then have the problem. Well, how do you secure the domestic yuan? And I think that it makes sense. I'm speculating here entirely, but it does make sense given that the history of the domestic market, the domestic Chinese market, was a silver standard. And there is this understanding, if you like, amongst the population that silver is money, whereas we've we just think it's small change. I think that it does make sense for them to go down that road. And for the same reason, I think it's also true of India. But it does require an effective separation between international yuan and domestic yuan. Now, they do have this with exchange controls. India also has it with exchange controls. So I think those two countries could do it. The yuan itself, when it comes to international trade, I think the Chinese see this as being the single currency which is acceptable to the whole of the Shanghai Cooperation Organization, BRICS, BRICS without Brazil, I'm afraid, and also the entire global South, being the, if you like, the general description of the whole of Africa and elsewhere. So outside the Americas. So I think that, to my mind, does make some sort of logical sense. And I think that's the way in which they're going. We can see it with gold. We've yet to see it with silver. But, is this why the silver is so strong in China? I mean, is this part of the story? Well, it's an interesting thought. I think that what we're looking at, if my suspicions here are correct, then we're looking at the gold-silver ratio certainly going back down to the sort of 15-ish level, which was pretty much what Sir Isaac Newton came up with when he was Master of the Royal Mint back in, 1720, 30, whenever it was. So this, I think, it's a big argument for silver going quite a bit further. And given that the gold is continuing to reflect collapse in the purchasing power of the dollar, then you can make an argument that silver could go 400 or 500 ounces quite easily. And the interesting thing is there are no speculators in there. I mean, normally, if you get speculators, it behaves like an investment. There comes a point where, they start taking profits or, the market makers, swaps, whatever, can then shake the trees and bring it back. You get a bear phase or, at the very least, probably a bear market. But this is a very different situation. This is not an investment game. This is a big, big monetary game. And it's the end of the fiat currency system. And that, I think, incidentally, is going to accelerate very significantly in 2026, because what gold is telling us, the relationship between gold and the dollar, is that the purchasing power of the dollar is going to fall a lot more rapidly than anyone thinks. Or put another way, the rate of inflation in 2026 and going into 2027 is going to be far, far higher than anyone at the moment can imagine. And that, I think, is going to be the big surprise on the markets.
Alasdair Macleod's message is blunt, and it cuts through a lot of the noise surrounding silver right now. What's driving this market is not speculation, not retail excitement, and not some sudden trading craze. It's the simple fact that when buyers stand for delivery in London or on COMEX, the metal isn't there in meaningful size. Much of the silver sitting in vaults is locked inside ETFs or held by owners who have no intention of selling. Even when that silver is accessed, it's effectively borrowed and must be returned later. That isn't supply. It's a temporary illusion that only works as long as no one insists on real delivery. What makes this situation unusually dangerous is the absence of the usual release valve. Open interest in silver is low, and gold's has been falling as well. This is not a market stuffed with leveraged speculators who can be flushed out with a sharp sell-off. The pressure is monetary, not financial. Paper silver is being steadily converted into physical silver, and that conversion exposes the mismatch at the heart of the system. Without speculators to shake loose metal, price drops don't solve the problem. They only reveal how little flexibility remains. Underneath it all, physical demand is leading, not following. Asia is pulling metal out of the system, while Western markets continue trading claims on silver that increasingly cannot be honored without stress. This is no longer a normal price cycle approaching exhaustion. It's a structural shift where confidence in paper promises is eroding and real metal is being treated as money again. Once that process reaches a certain point, it doesn't unwind quietly. It tightens, accelerates, and forces outcomes the market has spent years assuming could never happen.
I think it's probably worth commenting on what's happened today. I mean, we've fallen from 121 or something down to 108 and change. I think
Well, 112 at present.
Yeah, so it's bounced up here. I mean, the fact of the matter is that this is the last day of the February contract. Do you need to know any more? Gold and silver get panned. I mean, I was looking at gold, actually, which is interesting. And if you look at gold, you see that there's still 38, I mean, as of overnight, 38,672 February contracts still outstanding. So what do? You bang the price and try and shake the trees and get these guys to, to close out whatever, just get the hell out of it. I'm sure quite a bit of that will be standing for delivery, which is something else, which I think the swaps would try and discourage because they don't really want to get rid of physical. This is the problem. It's when we look at paper markets, the problem I think we have is not so much speculation. It's more demand for physical. The paper is being turned into physical. Now, we're not leading in this. It's China that's leading in it. I mean, we're overnight. I think silver closed on the Shanghai Gold Exchange at around about 135, something like that, and about 138, I think, on the futures exchange. So, these are very substantial premiums, and it's been like that for some reasonable time. So, and there isn't the arbitrage. I mean, what you're not seeing people sort of, if you like, delivering silver into China and trying to pick up on the arbitrage. That's not happening. And the interesting thing is that it's two worlds again, Jesse. I mean, I keep on hearing reports in the West about the amount of scrap silver and silver coins being offered to bullion dealers, and they don't want to take it. I suppose partly because it's so volatile and also because they can't refine it. I mean, there's no refining capacity. So who wants to take silver in these markets? But if you go to Asia, bear in mind that it was as recently as 1935. I know it doesn't sound recent, but China was on the silver standard. They understand that silver is money. And I remember as a youngster, I was sort of early 20s, late teens, I think, going to the Middle East. And Maria Theresa silver thalers, were circulating as money. And if you went to somewhere like Basra in Iraq in those days, I mean, there was a whole silversmithing business turning these things into, rings and, jewelry and all the rest of it. I mean, pretty low grade stuff, admittedly, but you can see that the idea that silver is actually money is something which is far more embedded in the Asian psyche than it is in ours. I mean, we've always seen silver as small change. Yeah. But not in Asia. This is actually, as far as they're concerned, real money, and has been for as long as anyone can remember. So the demand, if you like, when you can see that you've got geopolitical things actually happening, and you've got your own central bank rushing out and buying gold, selling dollars to buy gold, selling US treasuries to buy gold, as the ordinary person, let's say, in some regional town in China, what do? Do you go for gold? No, you go for silver. Of course you do. And this is why demand for silver has just gone off the charts. And at the same time, industrial demand is the highest it has ever been. I mean, when you look at photovoltaics and also electric vehicle demand for silver is just absolutely amazing. And India in particular is an economy which is now growing very, very rapidly. It's roughly where China was, say, 20, 30 years ago. And its demand for silver, industrial demand, is again off the charts. So there is no silver around. And, people are buying silver. Industrial users are buying silver, say on COMEX or in London, and effectively standing for delivery. But where does it come from? They haven't got any. If you look at what's in the London vaults, it's almost, not entirely, but it's very substantially ETF silver. which you can raid if you're an authorized participant. But if you raid it today, you've got to pay it back tomorrow. There's an awful lot of the silver which is held in London vaults, which is hoarded, if you like, and therefore not really available on the market. There is just no liquidity in the market. And if you look at the level of open interest in silver, it's low. It's low in gold as well. In fact, it's been collapsing in gold. I mean, we've got 465,000 odd contracts is the open interest in the gold and the COMEX gold contract, which is low. I mean, the idea that this is being driven by speculative interest is completely wrong. There is no speculative, or very limited speculative interest in certainly in COMEX, and I guess also in London. No, it's being driven by monetary factors, in effect, and in the case of silver and also platinum group metals, with industrial undertones.
Something much bigger is taking shape beneath the surface of the silver market, and it's unfolding in a way most participants are not prepared for. What looks like routine accumulation is actually a slow withdrawal of usable metal from the global system. As silver moves into long-term holding structures inside China, it stops behaving like a traded commodity and starts acting like a strategic reserve. That distinction matters. Silver that does not return to the market changes the rules for everyone else still relying on paper claims and just-in-time supply. The stress shows up first where the system is weakest, in price discovery. Futures markets assume that selling pressure creates availability, but that assumption breaks when physical demand absorbs every decline. Volatility spikes not because the market is unstable, but because it is being rebalanced. Sudden drops are followed by aggressive recoveries, not relief. Each cycle tightens liquidity further, forcing participants to question whether quoted prices still reflect what silver is actually worth when delivery is required. What follows from here is not a slow repricing, but a forced adjustment. If enough metal is removed from circulation, the market has only two options: ration demand or radically revalue silver higher to restore balance. That process does not wait for consensus, and it does not announce itself politely. By the time the shift is obvious, the metal is already gone, and the only real question left is who still has access when the system finally admits it. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.